Fantastic. Thanks for having me on the show, Jay. Very excited to be here. So people ask me, Neil, what's your podcast? And my answer is everyone else's podcast. And that works fine for me. And, people go to podcasts for certain reasons to spread their message. And my message is being spread really well. And I'm happy with that. I have every kind of smart home improvement in my house as possible. So I was trying to get my fireplaces to come on when I say, Alexa, Zen. Now it's going to start talking in the background, by the way, because it just heard its name. So when I use that word, I want the fireplace to turn on. I want certain lights to dim. I want the certain lights to turn on. I want a certain spa music from Spotify to play. And I want all of those things to happen at the same time. What? So that was my weekend to figure out that, the response that she would give to that particular word. And I succeeded at the end of it, though sometimes the fireplace doesn't turn off when it's supposed to. So I'm still dealing with that. Now, these are LED fireplaces. So it's a fake fire. But when it turns on, you have the option to say either A, I'm not going to use its word name, A, and then Zen or Zen with heat. When I say Zen with heat, the fireplace doesn't just turn on as an LED display, it also turns the heater on. So these are 1500 watt heaters. What you learn when you actually do real estate from scratch, right? Completely from scratch is insane. I see people all the time buying large multifamily properties. They have no idea how these things are ever built. And the knowledge is absolutely spectacular. And to a dork like me, I mean, geeks love this kind of stuff, right? So like I can walk into a room right now and look up and tell you what the occupancy of that room is. Like, doesn't that sound really dorky? I mean, but I can do that. Real estate was a weird initiation for me. It wasn't a flip. It wasn't a rental. It was a real estate can change my technology business. But today we have about $320 million of real estate, mostly multifamily, but we've got student housing and storage and industrial assets. We've got townhome assets. We're building 180 townhomes in a tertiary market called Idaho Falls, all kinds of assets, right? But it really started from this love of construction. I came here for a master's and never really got into it because I came here in 1997, at the end of 97, and the market was so hot. I mean, what people were willing to pay back then was a little bit insane. For somebody like me with only 3 years of experience, I just walked in at the exact right time. So I never really went back for my master's. I tell people, I think I have a master's in experience, and I think that matters more than a second degree. I wasn't the kind of guy that was fixated on a 4.0 GPA, and that's not even an Indian concept, but the equivalent of it. I wasn't fixated on it. I'm very much focused on applying technology, right? So even with real estate, if you look at what has made me popular out there, it's this course. So if you go to udemy.com/realfocus, you'll see this course. And you'll notice that there's at least 10,000 people taking the course at any point in time. So right now, go to udemy.com/realfocus. You'll see 10,000 people there. They're all taking this course. There's huge numbers of people that take it, and there's like 1,000 reviews on the course. It's the most popular real estate course on the Udemy website. They have hundreds and hundreds of them. It's the most popular one. And what's interesting is it's applied data science. Now, if I called it that, nobody would ever take it. So I didn't call it that. Right. So I called it location magic, the best cities and neighborhoods in the US for real estate investment, because that's really what it is. And people absolutely loved it and got me notoriety, both with people agreeing with me and loving the course. I mean, obviously with 1,000 reviews that people liked it.
Yeah.
But the fact that there were also people who disliked it, who said you're wrong. And I loved that because it was like, okay, I want to know what you're telling me that I don't understand. And a lot of these people had very legitimate points about things where they were successful in cities that I was bashing in my course, like Detroit, Michigan. And they were telling me, this is how you make money in Detroit, Michigan. I think I probably learned more there than I did while I was making the actual course and putting my real focus system. It's a set of metrics. So it's a set of 5 metrics at a city level and 5 metrics at a neighborhood level. And those metrics basically allow you to cherry pick cities and neighborhoods in the US for future real estate investment, not for the past, not based on past performance, but based on how it will do in the future. So a lot of that goes back to my computer science degree, understanding, statistics. I was a statistical major. And so I understood stats, and that allows me to have a little bit of a crystal ball. That's also why I like multifamily. Okay, a lot of people don't get this, but what I'm about to say, the moment I say it, it'll make sense to you. Anybody who's in apartments in multifamily has an 18-month crystal ball. And that 18-month crystal ball is actually really, really simple. It's ridiculously simple. Go to a market where home prices are going absolutely crazy, like 10, 12, 15, 20% home price increases. 18 months from the time that they start going crazy and start going into that double digit annual growth, you'll start seeing rents go crazy. Why? Because think about it. All these people that are in that city, what are they all trying? Nobody wants to live in apartments. Not one person that I know that says, I absolutely adore apartments. I would never live in a single family home. Everybody wants to live in a single family home. But what happens is, with incomes going up 3%, home prices going up 12%, each month there's a certain percentage of people that drop out of that race to buy a single family. They just know they can't get to it. They've tried, their income's rising slowly and home prices are going up. Like, it's never going to work. But that person, a month ago, they had this dream of being a homeowner. So when they finally move over to apartments, they don't go for a shitty apartment. They go for a nice one that's recently rehabbed because they still want some portion of that dream to live on. So if you are an apartment owner and you rehab your apartments and you've got the kind of countertops and the steel appliances, now that person comes in and says, okay, I couldn't get my dream, but this is the closest to it. I'm going to take this on, right? And that's why when we build new construction apartments, we build nice ones, we build balconies, we do some interesting stuff with them. We raise the ceilings up 10 feet instead of 9. We do those kinds of things because we know that emotion that's driving these disappointed people that say, hey, I almost was there, I almost was a homeowner, means that when they come in, they're in an emotional state. And that's what makes me successful. And anyone who's in multifamily that understands this can be very successful, right? Go to places that are incredibly hot right now for single family, and you'll do really, really well by the time your your multifamily assets are built or purchased. At that point, they know that they've lost the race to be a homeowner. So they have two choices: rent a single family or rent a big apartment. There isn't a third choice that I'm aware of, unless it's, live in my car or, live in grandma's basement. Some of them do, most of them don't, because at that point, they're still chasing their dream. And where they're living is an admission of defeat. And by either renting a single family home or renting a rehabbed apartment, they get away from that thought of defeat that, I tried to be a homeowner and it didn't really work for me because prices in Pensacola are going up 10%. My income's only going up 3%. It's just not going to work, right? So I think that there's a minority of people that do what you say, which is they just stay where they are. But others, they make a change, and that gives them that feeling of, okay, I tried something, I did something different. And the beauty of multifamily is that we only need a certain percentage of those people to make that decision. 1 out of 5, 1 out of 10. And that's enough, because if you look at the single family market, it's so enormous. There's so many single family homes in the US, but multifamily actually is a fairly small market in comparison. If you look at how many multifamilies we build in a year, it's like 300,000 in a good year. But single family, we never build less than 1 million, even in a bad year, right? So single family is a much larger market. Multifamily is a smaller market. So imagine a much larger market spinning off people for us. And that's what works for us, right? Also, there's this concept of cap rate where from your perspective, you're like, well, this doesn't really make sense. And the answer is, it makes sense if you think a completely different way. If you start applying cap rate methodology to multifamily, it makes sense. But if you start applying single family metrics to multifamily, it doesn't make sense, right? And then I have to make a confession. If your market is hot, if you're able to build single family homes and flip them on a value for your time basis, you're going to make more money than multifamily in most cases. Like I'll say overwhelming cases, 90+% of the cases. So then why would anybody do multifamily? Well, the answer is, the problem with single family is when you're finished with that flip, you're starting again. And a lot of people, they get burned out by that, even though it's actually the same actions that you're taking over and over again. But this is very common. People get burned out doing flips. They get burned out even doing rentals. Whereas with multifamily, we go in, we buy a multifamily. The first 12 months are insane amounts of work. We're improving it. We're repaving the parking lots. Right. We're changing the roofs. But at the 12-month point, now that we've done it, and now the whole property is new looking or nice looking, now it becomes much easier to convince tenants to take the newer rents because the whole property is done. Because once I'm done with that flip and sell it, all I can do is enjoy the money. And then to make more money, I have to start again. With an apartment, after my 12 months of work, absolutely, there's lots of work. The next 4 years, I'm spending very little time. There are properties where we are only doing a 30-minute meeting every month. And that is the sum total. And even if I didn't do that meeting, the property would probably do really, really well. So yes, you get 1 year of hard work, but then you have 4 years of enjoyment. And so that is what is different. And I can tell you, Jay, that the number of people that move over from flips to multifamily is pretty high. The number of people that go from multifamily, if they make it, back to flips is very low. So that is something that I've studied for a long time. And I think some of that is because they consider it going backwards. They don't want to do a unit at a time, even if they're making more money. A lot of it is, though, because they enjoy the capital gains benefits, the taxation benefits. Keep in mind, multifamily, most of the money that we make is capital gains. And you reach a point in your life where the taxes become much more important. But I have no doubt that Jay Helms is right, and there are people who've gone over to multifamily and jumped back to flips simply because they didn't burn out as much on the flips, right? I just find a lot of people do. You're right. Multifamily is getting saturated. I see saturation everywhere. I see, I can tell you this. I mean, I am a bread and butter multifamily guy. I buy value add properties. I have, hundreds of millions of them. The last time I purchased a value add multifamily was November last year. Okay. So it's been a year. I haven't purchased any. And you go,
which
so
for a guy like you,
company?
that's a big drought, right? So for a guy like me, that wouldn't be that big of a drought.
It's gigantic. It's massive, right?
Yeah.
And why am I not doing it? Because I am like you. I'm in the same mental place as you, that look, too many people piling on, too many people overpaying for properties. And what's happening is that the gap, so the way multifamily functions is there has to be a gap between old value add properties where you buy the property and you improve it and new construction, right? So there has to be a certain gap. And if that gap shrinks too much, then it doesn't make sense to be doing this value add stuff, because you're too close to basically being able to construct a new building and just hold on to it, or even buy a new building. I mean, there are syndicators in my business that are no longer buying value add. They just simply buy a new construction building that's 5 years old, which means it's new. Right? So they just buy it, and then they're like, we're going to just hold on to it because we're going to get pretty much the same returns and we're not taking any risks, right? They're not getting pretty much the same returns. They're getting lower returns, but their risk profile is much lower. And so I agree with them. So to me, you might wonder, what has this guy done for the last 12 months if he's not doing what he's supposed to be doing? The answer is, I'm building multifamily. So when that gap between value add and new construction drops, then I want to be on the other side. I want to be on the other side where I'm creating much more value, right? Value add is creation of value. New construction is creation of fantastic value, because you take a piece of dirt and you build a gorgeous building from it, right? So if you know how to do it, you certainly won't lose money. You might not make money if you get caught in the wrong times. The other thing that helped me, which I certainly didn't anticipate, by the way, this is just luck. So when we started doing new construction, we didn't start doing it last year in November. We started doing it like 2 years ago, right? Because we started seeing this, oh my God, I mean, every building in the world is called value add. Even if there's no value add, they still call it value add. It's nonsensical. And then COVID hit. And for a moment, we were like, oh my God, we're so screwed, right? What do we do with new construction? Then we realized something to our utter shock. The value add business, multifamily business, those lenders tightened up. Loans went from 4.2% to 6 or 7, making the whole deal not work. Right. And then on top of that, Fannie Mae and Freddie Mac, the two big lenders in the multifamily space, said, we want 9 months of your principal, interest, taxes, and insurance to be impounded with us before we give you a loan. And I don't know how this whole COVID thing is going to go. Let's take a look at new construction. Guess what they did in new construction? They said, nothing's changed for us. We're just going to be more strict with you on your liquidity. So keep more money liquid. So what I went out is I sold a bunch of homes that I had and put $1 million in my bank to increase my liquidity. That's what the banks wanted in case something went wrong. And then I started doing new construction deals, and the interest rates kept dropping from March, April, May, June, July. They just kept dropping, no impounds, because there is no principal to pay when you're doing new construction deals, right? It's always interest only. So I have ended up in this completely by accident, where last month I closed a loan on a new construction project at 4%, right? So the risk reward scenario has flipped around completely. And while I didn't cause it, I'm smart enough to know, oh, okay, it's benefiting me. So I'm taking advantage.
Yeah.
I don't think so. I think that while there are 3 or 4 scenarios that I thought of while you were talking that are similar to that, they are very niche scenarios. They're very edge case scenarios. The vast majority of multifamily, you have 2 scenarios, and one is closer than the other. So either on the multifamily side, you're building this big ass building, and until that building is built, you can't really sell any of it. I'm not doing a lot of that right now. You know what I'm building? I'm building quadplex townhomes. It's still multifamily, but I build quadplex townhomes, and then I sell them to investors even before I start building. But these are single family investors that take a single family Freddie Mac small balance loan to buy a quadplex from me. Multifamily takes 18 months to build, but a spec home, right? A quadplex spec home takes the same kind of 6 months to construct, like a bricks and sticks, single family home, right? So no difference there. So what you're doing is you're zoning that as a lot and you're selling it to individual investors as quadplexes. But how's it multifamily? Because I'm building 50 of them at a time, right? So 50 quadplexes is 200 units. And how am I hedging my bets? Well, firstly, I can sell each of those townhomes to the single family market if the multifamily market goes down. I can sell the quadplexes before I make them. Or if neither one happens, I'll just keep building them and hold them for rental. So I'm giving myself all 3 exits, right?
Yeah.
So, and these are not designed for maximum profit. They're designed for minimal risk. So when you build townhomes, you actually give up on a lot of profit, because townhomes are half the density of apartments. So you're building half as many, which means you can't quite get the same rents. But on the other hand, you have lots and lots of exits. I invest in Class C. So the 50% of my portfolio is Class C. Okay. And I still say it because I believe that Class C was the best investment 3 to 4 years ago. It turned out to be the case. Class C rents went completely insane. Their occupancy was higher than B and A, and their rents were rising faster. All of those happened over the last 4 years. Just check out any resource on multifamily and you'll see that. Today, I see that the situation has changed. And the reason for that is the same Class C property is now $30,000 a unit more. And we're edging up to where the gap between a Class B property, which is 20 years newer, has more amenities, looks nicer, probably doesn't have as many maintenance costs. We're now within $10,000 or $12,000 a unit of that. So today, I don't think that Class C is the best opportunity. Now, these are all cycles. Guess what's happening now is that Class B prices are going up, so that gap is going to increase. But today, the gap's too low, which is why I'm like, well, you should be buying Class B, or you should be doing new construction, because you're taking too much risk buying older, crappy Class C properties with, they're going to have sewage issues, their roofs are going to be old. There's so many problems that you're buying. And for $12,000 a unit more, you could skip all of those problems. Your job on behalf of your investors is to do what is known as best risk reward. And Class C right now is just highest risk, not necessarily highest reward. It's been a while. So about a year and a half. So I haven't bought anything in Class C for 18 months or so. I've been buying Bs. The one that I bought a year ago was a B. And it's done really well. So, no issues with delinquency, no issues with tenants not paying rents. Obviously, there's lower cash flow in a B than there is in a C, and I'm happy with it. So at this point, that's what I'm looking to do. But keep in mind, let me give you an adjunct to that Instagram post. I don't even consider multifamily to be the best asset class in the United States. I'm in multifamily. That's what I make my money on. The best asset class in the United States today, unquestionably, is industrial assets. Why? Well, this will resonate with everybody. In the last 8 months, we've had 8 years of e-commerce growth in 8 months. And when you switch from retail to e-commerce, you're switching from strip malls to warehouses. We need 2 billion square feet more of warehouses than we did in Feb. 2 billion. That's a ridiculously large number. It's going to take years to build 2 billion square feet of warehouses. But Amazon itself has forecasted that they will need 500 million square feet just for their own use. Right? And that doesn't really exist because how much of that could be built in the last 8 months in the middle of a shutdown? So bottom line is, I mean, there's no asset class right now like industrial. So a lot of people think, oh, we're going to tear this, we're going to go into this mall and we're going to build something in it. We're going to maybe build a multifamily or we're going to build a hotel. I can tell you 99% of the time, I've looked at this math, I've tried to do it, it doesn't work. Malls are very expensive land, extremely expensive land. They've got very specific zoning. In 3 out of 4 cases, when you buy a mall, you're going to end up ripping it down and building something on it from scratch. Reusing malls is actually a very, very difficult process, and most people can't do it. Believe it or not, the best reuse actually is industrial. But how can you do it when you're buying even a distressed mall? You're buying at $3 a square foot, and you can buy a new industrial at $1.25. So they don't do it simply because it never makes any sense to them. It's very difficult. And a lot of people, again, are like, I can turn my strip malls into industrial. No, you can't. They don't have roll-up doors. They don't have ramps. They don't have any of those things. You can't really ever do industrial with these things. So your choices are actually pretty narrow. There's only certain things you can do because of zoning and city laws and stuff like that. So it's a very difficult ask. What I think is going to do is some of them are going to get repurposed for things like senior housing, which, there's going to be a boom in senior housing over the next 10 years. And you can take some of the strip malls that are zoned a certain way, and you can basically convert them into small senior housing projects. And then medical office. So we just went through the greatest, healthcare emergency in modern history. Well, as a result, as you can imagine, nobody anywhere will be cutting down healthcare budgets. It just will make no sense. Now you have, and then you have this new concept of, do we need to do X and Y, which previously we didn't have money for. Now we need to do it simply because we can't tell people, oh, we knew about COVID and still didn't do some of these things. So bottom line is healthcare budgets are going to keep rising, which means that there's a number of different healthcare aspects like immunology and infection disease, infection control. These are all things that will see boosts, and you can very easily take small strip malls and start converting them into medical offices that are not specific need. Like a dentist medical office is very specific need, water requirements and sewer requirements, but immunology does not require that. So you can basically take that and reuse it. So I think that they'll get reused a lot. I also think they'll get torn down a lot. So I think that the retail apocalypse is upon us. Yeah. Because the president of the United States is the chairman of the Fed when it comes to the real estate people. If you look at what has happened in real estate in the last 10 years, none of our gains, or I should say a very small percentage of our gains, have come from what any Republican or Democrat has done, failed to do, or anything related to that. The vast majority of our money has come in because the Fed over the last 15 years has completely changed the way that they do business, flooding the market with humongous amounts of money. They call it quantitative easing, QE 1, 2, 3, 4, QE forever, and then cutting interest rates, right?
Now, by the way, your propeller head was just spinning like a top just then.
Yeah, that's right. That's right. Those people, they are the ones that are controlling our destiny at this point in time. If you're a real estate investor today, you're in a very, very good place. 48 out of 50 markets are hitting all-times high. In the middle of a pandemic where we can't even evict people, there are no price drops in multifamily, which makes no sense until you understand that we also have the friendliest Fed in history. They're friendly beyond all reasonable, assumptions. And so to me, the only time when Republicans or Democrats make a difference, anytime they move the needle, is when a party has the Senate and the presidency, and they're very, very close on the House. So they're very close, which certainly wasn't the case. Obviously, the Democrats had full control of the House for the last 4 years. So what we have today is a hung presidency, a president who, in this case, it's going to be a Democrat president most likely, and he's going to have to basically deal with a Republican Senate and a House which is fractured. His own House is fractured between left and far left. His ability to do much is restricted. Now, you might think that that's bad. Yes, it's horrible for the country, but we're talking about real estate. Real estate actually thrives when there's hung governments. And we haven't really had anything but a hung government. Obama had a clear mandate from 2008 to 2010, didn't manage to do anything except Obamacare. So that's one thing that he got done during the time when he had mandate. Then Republicans had it for a couple of years, and they managed to get the tax cuts, their tax cuts. That was a big one for them. They managed to get that done. That did help real estate, right? So my point was, if you control presidency, Senate, and House, you can get stuff done that can hurt real estate or help real estate. But otherwise, it's the Fed. It's the Fed. President Trump has been involved in hundreds of lawsuits in the last 30 years. If somebody is disenfranchising Trump, he knows how to take care of that.
Yeah.
No one knows how to do that better than President Trump does, right? Yeah. So if somebody is screwing him, he's going to have a million lawyers up their ass. Yeah. Given that you don't have a million lawyers, just get on with it. Once again, that was specific to multifamily. So in the multifamily arena, I actually, Jay, know more than 100 people that over the last 2 years have made substantial amounts of money. They've never invested a dollar of their own money, and they probably invested a little bit of an education. And they've done something that I actually don't advise doing. But it doesn't change the fact that it's true. I'm against it. I advise against it, but it's true. And that is that in the multifamily arena, there's so many investors who do not want to basically buy their own multifamilies, build their own, improve them. They're looking to do passive investment. And you mentioned that word earlier in this interview. You mentioned passive investment. And I know of more than 100 people who just go out and find these investors and connect them with opportunities that other people have put together. Mm-hmm. Now, do I do that? No. Have I ever done that once? Have I ever paid somebody 1 cent to connect me with passive investors? No. But A, that doesn't make it wrong. And B, I'm a nobody, right? There's 10,000 properties being worked on. So what I do doesn't matter. What matters is that there are literally thousands of projects right now where people are simply doing introductions. They're doing it in a way that is legally extremely fuzzy. Let's just say, we'll call it gray. That's correct. And even if the investor is accredited, even then there are laws that people are not necessarily towing the line on. But for the moment, we have a very flexible and friendly SEC, the Securities and Exchange Commission, is also filled with Trump appointees who are very friendly at this point. We'll see what happens with Biden. But at the moment, they're really not out there beating the crap out of people for doing this. So when you learn how to connect passive investors with people who buy multifamily properties, it's truly one of those cases where you're not investing money. Oddly enough, I don't have I recommend it in a modified way. I say, do that because it helps you get started, and then get out of it as quickly as you can. Okay? Yeah. So think of that as a stepping stone. But if you do it more than twice or thrice, then I think that you're cheating yourself. You're cheating yourself out of a future. You gave yourself the credibility. You gave yourself the ability to get started. You gave yourself money in your pocket. And then you basically just kept doing the same thing. Just like people who do, they kind of flip contracts to people, right? A lot of them say, I flip contracts to build up wealth. And then I use that wealth to do my own flips or to do my own rentals. It's just a ways to a means, right? That's what I mean. Raise money for other people, do it a few times. You'll get a bunch of investors that will follow you because they think that you're the one that these are not your projects, even though they're not. And then do your own projects. So if you listen to all of it, I'm not opposed to it. The vast majority of times people say these things, they do it for clickbait reasons. And there's no doubt that my Instagram team made the same, did the same thing. In my case, obviously, I gave you a full explanation, which Instagram doesn't allow me to. But I think that as far as I know, my social media team is as clickbaity as anyone else's. And I think that most people who say that you don't need money to make money are either they have a backup explanation that you should hear, or they're just trying to get eyeballs and they don't care about the unethical nature of their statement. For people that are interested in learning more about any kind of commercial asset class, whether it's multifamily or storage or industrial or student housing, senior housing, check out multifamilyu.com or type Multifamily University into the web. We do about 20 webinars a year. About 50,000 people attend these webinars. And they are deep dive webinars, very content rich, extremely content rich, and extremely eye candy. We love creating beautiful presentations. And so check those out. They're free. They're always meant to be free. We also have a real estate toolkit that we update 4 times a year, and it's extremely powerful. It has incredible amounts of content on what you should be doing. It basically is a toolkit for people that want to empower themselves on whatever kind of investment they may be looking to do, not with us, just by themselves. So those are 2 things that you should check out, Multifamily University. If you want to know where to invest in the United States, what are the specific ways to invest in the US, what cities, what neighborhoods, go to udemy.com/realfocus, and you'll notice that there's about 10,000 people taking my most popular course. And then if you're interested in passive investment, we are distributing millions of dollars each year of passive cash flow to our investors. We've invested over $60 million of investor money into multifamily, student housing, industrial, townhomes, new construction, value add, all sorts of assets. So it's a very diversified portfolio, but you get to pick the assets that you're interested in. For that, check out growcapitus.com. That's GRO, no W, GRO Capitus, CAPITUS.com, and you'll see some interesting stuff, including tons of investor evaluations and reviews of people that have gone full cycle with us on their investments. So check out growcapitus.com.